Historically, there is a known correlation between investment property cap rates and bond yields. So in this video, let's take a deeper look into historical trends and what this might mean for real estate cap rates. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. As a quick refresher, real estate investors often look at cap rates, so you should probably get familiar with this. The cap rate is calculated as your NOI divided by your property value. So if you are investing in real estate without a mortgage, this is your net income yield. And generally, when you look at different investment opportunities, you would use the risk-free 10-year government bond yield as a baseline, and you'd stack all other investments against it. The cap rate on investment properties would be higher than the risk-free rate, and that's simply because you should be compensated for taking on a higher level of risk. And when you stack the cap rate against the 10-year bond yield, you will see a consistent spread between the two. Basically, when bond yields are higher, the cap rate would need to be higher as well. And when bond yields fall, the cap rate would also fall. And now, most people automatically assume that the spread between the two should be the same throughout. But when you look at history, it actually turns out it isn't. Take a look at this chart that compares 10-year government bond yields with Canada multifamily cap rates since 2008. And as you can see, when bond yields are lower, the gap widens. And when bond yields peak, the gap actually compresses. At the moment, we haven't actually gone past the peak set in June, despite all you hear in the news with bond yields spiking. And more recently, we just saw Australia slow down rate hikes to 25 basis points below expectations. Poland actually paused interest rate hikes, and the UN and other investment experts are putting more pressure on central banks to slow down interest rate hikes to prevent a hard recession. So based on all of this new stuff happening, we believe that the 10-year government bond yields have peaked at this point. So going back to the cap rate chart, the spread at the peak between cap rates and the 10-year yield is around 2.25%. And right now, the 10-year bond yields are closer to 3.25%. So if history repeats itself, cap rates for multifamily homes in Canada might actually peak at 5.5%. Now, if you don't believe that this time around history will repeat itself, here's another way to look at things to help you understand why the spread actually compresses when interest rates peak. Here's the thing, investors don't usually buy real estate with just cash. So instead of just looking at cap rates, they're also looking at cash flows after you pay off your mortgage payments each month. And what happens is that when interest rates are higher, the spread between cap rates and interest rates can actually be compressed to maintain a similar level of cash flow. To understand this, let's head over to a mortgage calculator. When interest rates are lower, you can see that the principal paydown portion is around 2% of the property value. In other words, you'd need roughly around a 2% spread between your interest rate and your cap rate to have a bit over break-even cash flows. If we bump up the interest rate to 4%, you can see that the principal paydown portion drops to 1.4%. And if interest rates get to 5.25%, which is the average 5-year fixed rate right now, the principal paydown drops down to 1.1%. Basically, because the principal paydown portion goes down when interest rates go up, this is the big reason why the gap between cap rates and bond yields can compress when rates are higher. Now, the next thing you have to keep in mind is that investors know that interest rates fluctuate over time. Realistically, even if you enter at higher interest rates, you're not actually stuck with them forever. So as long as the price is right and the numbers still point to strong cash flows, investors will be willing to take a temporary hit on slightly lower rent yields to benefit permanently from deep discounts. The current market in Toronto is still very weak, and after another scare from September's rate hike and a hawkish-sounding Bank of Canada, a lot more buyers got scared off again last month. Honestly, it's less because of fundamentals and more because of fear. But this also means that if you are buying these days, there is a chance that you can get better than normal deals, much better than the average 25% drop from the peak that we've seen so far. And the numbers are still strong for investment properties in Toronto. You can get similar cash flows at higher interest rates, and you also benefit from huge discounts. Right now, we are back to early 2021 prices at least, and when prices rebound, this means you'll end up better off compared to everyone who's bought since then. So if you want to see what the best deals look like in Toronto these days, we're happy to chat. We're a real estate sales brokerage that focuses on investing in freeholds in core Toronto, and we search the market every day. When you work with us, we take the time to understand your needs, teach you the ropes, and help you buy the best investment property for you. But that's not all. Our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.